At the end of a period, after all transactions have been recorded and accounts have been adjusted, accountants take the account types and arrange them into financial statements. The four financial statements are the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. The first financial statement is the income statement. The income statement reports revenues and expenses. It shows how successful or not a business has been during the period. It covers a specific period of time. This is the skeleton format of the income statement. Revenues minus expenses equals net income. If expenses are greater than revenues, there could be a net loss. The brackets in accounting symbolize negative figures. Sometimes accounting uses red to symbolize negative figures as well. The next financial statement is the retained earnings statement. The retained earnings statement shows what the organization is doing with its earnings. Remember, we said that at the end of a period, an organization can decide whether or not to keep money in the company, to grow the company, or return something to the shareholders. The retained earnings statement covers a specific period of time. The skeleton form of a retained earnings statement looks like this. Retained earnings beginning plus net income minus dividends equals retained earnings ending. If it's a brand new business, the retained earnings at the beginning of the period will be 0 because there will not have been any retained earnings yet. The next financial statement is the balance sheet. The balance sheet reports assets and claims to those assets. The balance sheet will show whether an organization relies on debt or equity to fund its assets. The balance sheet covers a specific point in time. The skeleton form of a balance sheet looks like this. Assets equals liabilities plus equity. This should look familiar. This is our basic accounting equation that we have learned. The last financial statement is the statement of cash flows. This reports cash flows from the three principal business activities, which are operating, investing, and financing. This shows whether the organization has enough cash to fund its activities. The statement of cash flows covers a specific period of time. The skeleton format of the statement of cash flows looks like this. Cash flows from operating activities plus or minus cash flows from investing activities, plus or minus cash flows from financing activities, equals the net increase or decrease in cash. We add this amount to the cash at the beginning of the period, and this should match the cash at the end of the period. We will cover the statement of cash flows in depth at the end of the semester. There are examples of these four financial statements in your textbook. The full financial statements include many different categories under each account type represented. However, it's important to know the skeleton format of the four financial statements. This will help you get a better understanding of what's going on and the relationships between the financial statements. It will also help you answer your exam questions. Let's practice using the skeleton forms of our balance sheet, income statement, and statement of retained earnings. If liabilities are $90,000 and stockholders' equity is $230,000, what is the amount of total assets? We're going to use our basic accounting equation, the skeleton format of the balance sheet, to solve this question. I'll go ahead and give you the answer. The answer is $320,000. Well, how did we get this? Well, if assets equals liabilities plus stockholders' equity, we can fill in what we know and solve for what we don't know. The question tells us that liabilities are $90,000 and stockholders' equity is $230,000. Assets must be $320,000. We are simply solving for x variable being assets in this case. The next example is similar. If total assets are $160,000 and stockholders' equity is $60,000, what is the amount of liabilities? The answer is $100,000. Again, we're using the basic accounting equation, aka the skeleton form of the balance sheet, to solve this. Assets equals liabilities plus stockholders' equity. Let's fill in what we know and solve for what we don't know. We're trying to figure out what liabilities are. We know that assets are $160,000 and stockholders' equity is $60,000. We subtract $60,000 from each side, we're left with $160,000 minus $60,000 equals liabilities. Liabilities equals $100,000. Again, we're solving for x, except this time our x variable was liabilities. Let's change things up a bit. This time let's solve for net income. Net income is the difference between revenues and expenses. Revenues are amounts coming into the company because of sales of goods or services. And expenses are assets used to help us earn those revenues. Those assets used could be cash or could be other assets. Okay, so if revenues was $200,000 and expenses was $55,000, what is net income at the end of the year? Sometimes we think of net income as kind of like our profit. It's what's left over after we pay all of our expenses. The answer to this is $145,000. All right, revenues are $200,000 and expenses were $55,000. So that's how we get net income of $145,000. $200,000 minus $55,000. On this next example, we will be looking at retained earnings. The company began the year with retained earnings of 0, so this must be a brand new company. During the year, the company recorded net income of $75,000 and paid dividends of $5,000. What was retained earnings at the end of the year? Well, if we're looking for retained earnings, we'll use the retained earnings statement. The answer to this question is $70,000. The retained earnings statement is retained earnings at the beginning of the year plus net income minus dividends equals retained earnings at the end of the year. So if retained earnings at the beginning of the year was $0 and net income was $75,000, dividends were $5,000, retained earnings at the end of the year must have been $70,000. This is the final example. We'll need to use a couple of different things to solve this, both the retained earnings statement and the income statement. Okay, the company began the year with retained earnings of $500,000. During the year, the company recorded revenues of $387,000 and expenses of $279,000 and paid dividends of $38,500. What was retained earnings at the end of the year? I'll go ahead and give you the answer again. The answer is $569,500. Okay, how did we get that? Well, we know we're looking for retained earnings, so let's start with filling in what we know on the retained earnings statement. Okay, we know that retained earnings at the beginning of the year was $500,000. We don't know what net income was, they don't give us that. But we do know that $38,500. Okay, we still don't know what retained earnings at the end of the period was. We need to find out what net income was to solve this problem. How do we solve for net income? Well, it's revenues minus expenses. They give us both of those things. We know that revenues are $387,000 and expenses are $279,000. So net income must be $108,000. Let's plug that into our retained earnings statement. Net income is $108,000. Okay, so $500,000 plus $108,000 minus $38,500 equals $569,500, and that is retained earnings at the end of the year. Did you catch that on the last slide? The income statement and the retained earnings statements are related. Let's look at this closer. Okay, we said the first financial statement we will create is the income statement. The income statement is revenues minus expenses equals net income or net loss. Then the second financial statement we will create is the retained earnings statement. Retained earnings at the beginning of the period plus net income or loss minus dividends equals retained earnings at the end of the period. And the third financial statement we will create is the balance sheet. Assets equals liabilities plus equity. Why do we create the income statement first? Well, we need net income in order to complete the retained earnings statement. See how net income flows over from the income statement to the retained earnings statement. And we need retained earnings at the end of the period for the stockholders' equity section of the balance sheet. Remember that stockholders' equity is made up of contributed capital and retained earnings. Contributed capital is sometimes referred to as simply common stock in the early chapters of your textbook. Retained earnings is made up of net income minus dividends. Net income is revenues minus expenses. We could take our basic accounting equation and expand it into assets equals liabilities plus contributed capital minus dividends plus revenues minus expenses. Again, sometimes in your early chapters, contributed capital will be simply called common stock.